Investors continue to digest a steady stream of earnings from some big U.S. banks. Our next guest remains bullish on earnings south of the border, and he expects S&P 500 earnings per share growth this year of about 11%. Dec Mullarkey is Managing Director of Investment Strategy and Asset Allocation at SLC Management. Hi, Dec. Thanks for being with us.
Good morning, Mark. Great to catch up.
All right, so we've seen a number of big U.S. banks come out with their numbers the last couple of days. They've all appeared quite healthy. What's your take? What's your overview?
Yeah, they certainly were impressive. I mean, in fact, in aggregate, the first four that reported, it was like their second best in history. And it came down, very strong across, some of the Trump effect in terms of trading was up, deal making was up. And then when you look across the consumer, things in very solid shape there in terms of credit experience and how that's coming through. The one thing is loan growth is still kind of slowish. JP Morgan's numbers were like growth, our loans up 2% growth on that. And then although Bank of America this morning is reporting like 4% loan growth. Now, Jamie Dimon did address that on the call. He said basically, there's a lot of positive things, and there's a lot to like about the status of middle market companies in terms of their confidence in everything. So they're expecting loan growth to improve. But again, a very, very solid earnings, and that was coming through. So it was strong.
And Dec, do you think that U.S. financials will benefit under a Trump administration, and just in terms of lighter regulation, maybe advantages and some possibilities for some M&A?
Yeah, absolutely. I mean, certainly there'll be no M&A with the larger players. I mean, they've consolidated to such a size that there's no room there. But regional banks, there's no question. I mean, the things are playing into it, lighter regulation, and particularly what they call this Basel III endgame, where they were expected to maybe hold 16% more capital than they have right now under that. It looks like that is not going to get enforced, and that goes away, and therefore then it encourages a lot of these regional banks to consolidate more and take advantage of those savings, and that's what's really in play, and that's the expectation that that's going to work through. And there's other things too about the fee gouging, and there was some things in play around that. They're probably not going to get enforced. So that's a big part of it, yes, that you will see some of that consolidation within the regional banks. And certainly when you look at sectors that have benefited in this post-election effect, banks stand out. I mean, there's no question the market has felt, okay, this deregulation is for real, and that's coming through in the numbers, and the expectations are pretty high that there's going to be more consolidation happening.
And broadening it out, Dec, which sectors do you think will ultimately benefit under a Trump administration?
So it's interesting that I think there's going to be a broadening out, just absent a Trump administration or his policies, but you'll see more of that happening. But I think maybe it's easier to say which ones are maybe question marks. I mean, healthcare is one where they may suffer more, because I think there might be some effects, although that could force more consolidation. And I also think it depends on the tariffs. I mean, that's a big issue, and consumer staples have been weak because they're one of those sectors that really would, obviously be hurt by import costs of importing apparel. But again, financials will continue to benefit. I think tech is in generally in a good place, although they could be in the sights here for maybe some clampdown in different parts. But you also see industrials should do well, because I think there'll be more growth on that front. And the one sector though that is getting hurt is real estate, and that's because of rates where they are. But that's also rates are gone up for a number of reasons. The growth outlook certainly is helping, and they are driving some of that, and the expectation of rate cuts has died off, but also, or has cooled. But also the fact that you do have higher rates, that's put home builders are down quite a bit. And you see that in commercial real estate as well. So those are suffering, but that is more of an issue around higher rates, which is also a function of probably have higher deficits here because there's no evidence that there's going to be discipline around getting that debt down. And markets are, pushing back on that issue right now. So we'll see where that goes.
Right, we're definitely seeing that with higher bond yields, and some people are skeptical that they're going to do what they say they're going to do in terms of cutting the deficit. And just lastly here, what's the worst case scenario, best case scenario in terms of tariffs? Do we see an all-out trade war with a whole bunch of retaliatory and tit-for-tat tariffs, or will it maybe not be as ugly as some expect?
That would absolutely be the worst case, Mark, you described, like a universal tariff across the board, and then it just continues with, as you described. The case that markets, for the most part, have priced in is continued, tough take on China, but the rest will be pretty targeted in terms of maybe the auto industry has an effect, but the expectation is that happens pretty quickly, and you get the rule, you get those rules in place. The other risk, though, that and this could be would be a problem here, is that if Trump continues to just breed uncertainty around tariffs, just keep lingering it out, and continuing to use them as this ongoing threat, I think that would stall investment. I think it would install probably hiring at some companies because they'd basically be looking for certainty and for that noise to die down. So that's another one of those things that really could get overplayed. The good thing, he's very responsive to how the stock market's performing. So that feedback would probably calm down some of that.
Yeah, that's a good point. All right, thanks for your time today, Dec. We'll talk to you again. Dec Mullarkey,
thank you.
Managing Director of Investment Strategy and Asset Allocation at SLC Management. Now, yesterday on Market Call, we were